Okay, so we're going to start back on, I believe this was August 12th, if I'm not mistaken. When I sent this, let me just double check that date so that way we know for a fact when this was. Let's go back, just so that way you can see how long we've been talking about this collectively speaking. This is the general chat. Hold on one second. Let's go back to August chat. Oh, excuse me, August 12th in the CYPRX chat. August 10th, August 12th. I'm pretty sure it was this one. Okay, yeah, so it was. All right, so August 12th. All right. August 12th, we had really started to focus in on, I did not trade the first like 2 weeks of August. So that puts us to the Monday, the second week of August is when I started to really dial in trading for that first week. And I mentioned to you guys in this analysis, so we're just going to do a review. GBP USD holds steady in the early North American trading session, up about 0.06% at the 1.2765. As traders await crucial UK employment data on Tuesday and the US CPI figures on Wednesday for insights into central bank policy direction. If these data points suggest stable inflation on the UK front, it could propel GBP USD higher. Although the Bank of England has been ahead of the Fed in cutting rates since August 1st, futures markets continue, according to the LSG IRPR page, to price in that the Bank of England is expected to reduce rates by a further 43 basis points by year end, totaling a 68 basis point cut for the year. In contrast, that means inversely, the Federal Reserve is projected to cut by 101 basis points during the same time period, potentially providing support for the Great British Pound moving forward as the markets start to price in a less dovish Bank of England stance, excuse me, compared to the Fed for the rest of 2024 heading into 2025. So I said, let's break this down in detail. And we're just going to read the GBP USD sections in each of these reports. So we're just doing an overview real fast of the past 2 weeks. Okay. I said to you guys, central bank divergence, Bank of England versus the Fed. The Bank of England is expected, as of right now, with time of recording this report, which was the 12th of August, is expected to cut rates by 68 basis points by the end of 2024, while the Fed is only projected to cut more aggressively by 101 basis points. This difference in the pace and extent of rate cuts between the two central banks is known as central bank divergence. Impact on currency strength. Relative interest rates. Currencies often strengthen with their central bank, when their central bank is perceived to be less dovish, less inclined to cut rates compared to other central banks. In this scenario, while both the Bank of England and the Fed are cutting rates, the Bank of England's smaller rate cut, i.e., 68 basis points, compared to the Fed's larger rate cut, 101 basis points, suggests that the Bank of England is going to be less aggressive in easing monetary policy. This makes the Great British Pound relatively more attractive than the United States dollar. We're going to talk about investor behavior and capital allocation, shifting capital flows. As investors seek higher returns, because remember, these organizations that we're trading up against are profit driven, just like you and I, they want to make money. They are likely to shift their capital towards currencies associated with less aggressive rate cuts. In this case, the Great British Pound, this capital inflow into the UK could increase demand for the Great British Pound, driving up its value. Risk perception. Investors may also perceive the Bank of England less dovish stance as a signal of greater confidence in the UK economy compared to the US economy. This could further enhance the attractiveness of the Great British Pound denominated assets. Support for the Great British Pound, higher yield and confidence. The combination of a higher relative yield and investor confidence can bolster the Great British Pound. Even though both central banks are in the process of cutting rates, the smaller rate cut by the Bank of England implies that the UK economy might not require as much monetary stimulus as the US economy, which could be interpreted as a sign of relative economic strength. In summary, the divergence in pace of rate cuts between the Bank of England and the Fed could lead to a stronger Great British Pound as investors seek to allocate capital to a currency with relatively higher yields and potential stronger economic fundamentals. So, looking at on August 12th, the screenshot that I gave you guys, you can see that the price was at roughly around the 1.27843, and we had projected that as long as price is above the 1.27 flat, we were going to start to see these bullish targets come into fruition. The 128.625, which we got that week. The following week was the 1.29225. And then this week, we accomplished smashing straight into the 1.30425. So overall, this analysis that I sent you guys over 2 weeks ago was accurate. Then I gave you guys an update where we talked about the dollar index and why the dollar index was seeing weakness. You need to understand this because, again, we're trading the Great British Pound up against the dollar. So we mentioned on August 19th why the dollar index dropped significantly. On Monday, hitting its lowest point in 7.5 months, this decline was driven by dovish remarks from San Francisco Fed President Mary Daly and Minneapolis Fed President Neil Kashkari, who both indicated a willingness to consider a rate cut at the up-and-coming September FOMC meeting. Additionally, expectations of the central bank divergence has strengthened the yen, pushing it to 1.5-week high against the dollar. As the Fed is expected to begin cutting rates next month, while the Bank of Japan is anticipated to continue raising rates, the dollar loses were further extended by weaker than expected US July leading indicators. So we were just talking about this in general, why the dollar was depreciating in value. Market was pricing in at the time of writing this report, 100% probability of a 25 basis point rate cut and a 24% probability of a 50-point rate cut at the September 7th to 18th FOMC meeting. All right, I gave you guys a report so you can click and you could have read all that. All right. And we were just here talking about the dovish sentiment. We were here talking about how there was still strength in the Great British Pound up against the dollar, as the markets were also expecting that during the FOMC meeting in minutes, we were going to see a dovish sentiment from the Fed continue. All right. So just wanted to reiterate that and review that real fast. We had been talking about that on the 12th of August, then on the 19th of August, and then this is from the day after on the 20th. So we mentioned this week, the standout achievement was our accurate analysis of the Great British Pound against the US dollar. On the 12th of August, we highlighted in a report that the divergence between the central banks, Bank of England and the Federal Reserve, would significantly impact currency demand. We anticipated that as the market began to price in more interest rate cuts from the Federal Reserve and fewer from the Bank of England, demand for the Great British Pound would increase, while demand for the US dollar would decrease. This shift occurs because a higher interest rate environment in the UK compared to the US makes the Great British Pound more attractive to investors seeking better returns. As of time of writing, all of our bullish targets on the Great British Pound have been reached, delivering over a 100 pip gain called out to you guys well in advance. All right. And so these were the reports leading up to today's trade idea, which in last night's report, as you guys can see, scrolling right down here, this is the most updated report that I gave to you guys last night before both of the moves today came into fruition, August 21st, 2024. As of time of recording is the 22nd. So this is the report that you guys had last night. I mentioned to you guys dollar weakness continued. Going over those factors here in this segment of the report. And then scrolling all the way down to the bottom is where I gave you all my overall analysis of GBP USD. So I said, and we're going to just focus on these two portions. As anticipated, the divergence between the central banks played a crucial role in driving market dynamics. We observed a significantly higher demand for the Great British Pound compared to the US dollar, as market makers priced in a more aggressive interest rate cut from the Federal Reserve and fewer from the Bank of England. Today, the Great British Pound, this was yesterday, advanced for the fifth consecutive day, edging closer to the 1.3100 mark, following the data from the U.S. Bureau of Labor Statistics, which revealed that the U.S. economy added 800,000 fewer jobs than expected. That is bad, right? That signals a possible recession on the forefront for the U.S. economy. That creates less demand for the dollar and more demand for other assets like the euro, Great British Pound, gold, yen, so on and so forth, right? At time of writing this report, GBP USD was up 0.42%. Looking ahead, I mentioned to you guys yesterday, the focus will shift towards the U.S. unemployment claims, which today came out elevated, still showing signs of cooling labor market figures with a slight uptick of about 4,000 unemployment claims, and PMI figures, along with the UK PMI data. So I mentioned to you guys two scenarios could unfold, and I gave you guys my trade ideas. I said if the UK PMI figures come in strong, which they did, During the New York session, and the US data shows weak unemployment claims and lower PMI readings, which we'll talk about in just 1 second because we got the mixed reading today, we were likely to see continued intraday demand for the Great British Pound, albeit some potential slight profit taking. And you guys can see in this pre-planned analysis, you can see where the pullback had started. I mentioned to you all that we will continue to look for bullish opportunities as long as price is above the 1.29500. So even if price were to have pulled all the way back to these areas of interest, I would have still been looking for buys. But you can see that I was looking for price to come back up into this area of interest here at around the 1.31100. Looking at today's price analysis, just showing you guys the screenshots and where I sent all this information. Here is where I mentioned that if the UK PMI figures came in strong during the New York session and the US data showed weak unemployment claims, sorry, excuse me, this is supposed to say the UK PMI figures came in strong during the London session, and the US data shows weak unemployment claims and lower PMI figures, we were likely to see a continued intraday demand for the Great British Pound, right? So you can see that I put that information out when the prices were pulling back during Asia session last night. And what happened during London session? During London session, you can see at 1:30 a.m. Pacific Standard Time, you can see this massive bullish candlestick. The UK data came out, and we can see the UK PMI figures, and the data signaled another solid expansion. That's a key vocabulary word. Write that one down. For bullish momentum on a specific asset, expansion is one of those key vocabulary words that you're going to be looking for. The opposite of expansion is contraction. So if this data came out in contractionary ranges below the market forecast or below the previous readings, we would have seen this report say US PMI figures came out weaker than previously recorded in a contractionary range. And we would have most likely seen investors sell off during the London session. But we saw the opposite. Solid expansion of UK private sector output supported by a robust upturn in new order intakes. Rising business activity and resilient demand conditions contributed to a greater uplift in staff hiring, with the rate of employment growth at its fastest pace since June 2023, right? And I mentioned to you guys in this report, one of the factors that would contribute to demand for the Great British Pound would be if we saw upbeat UK PMI figures. So that was check one for today's trade idea. When I came into today's New York session, I saw that last night during London session when I was asleep, uplifted UK PMI figures came into fruition. So that was one of my confluences for today. Then at 5:30 a.m. this morning, we had the US unemployment figures, where we can see at 5:34 a.m., which by the way is a significant little tiny gem that I think that myself and Justin have given you guys. Markets usually like to move for some odd reason 4 minutes after the news. So if the news comes out at 5:30, you're looking for a trade set up at 5:34. If the news comes out at 8:30, you're looking for a trade set up at 8:34. Me and Justin in the CYPRX 3.0 content have broken this down for you guys, I believe, if I'm not mistaken. And if not, then I'll get on making a video about that. I've even noticed that the reports for these news fundamentals come out at 5:34, 8:34, 10:34, so on and so forth, right? But anyways, besides the point, we saw the number of seasonally adjusted initial jobless claims in the United States observed a weekly rise of 4,000 to reach 232,000 in the 7-day period ending in August 17th. The Department of Labor Statistics said in its report published on Thursday. So we're still seeing cooling in the labor market, more people filing for unemployment, which tends to weigh on the strength of the dollar as the markets price in, obviously, of course, bad labor market data, less resiliency in the dollar, more resiliency in assets traded against the dollar, right? And at 5:34 a.m., we saw that bullish move. And I'll get into my trade breakdown in just 1 second, but that created more of a demand during the beginning of New York session for the Great British Pound and less for the dollar. Markets rallied up, poked above these highs briefly, and since then we have retreated slightly. This is primarily because, like I mentioned in the report, I said conversely, if the US data shows any strength, this could lead to a pullback from the recent bullish rally. And so, yes, we still had downbeat figures in the US unemployment claims, but the US PMI figures are still showing signs of strength and resiliency. And that is what contributed to some profit taking in the Great British Pound today and some slight strength in the dollar. As you can see from this report, the US dollar gathers some strength against its rivals after the PMI figures showed that the private sector continued to grow at a healthy pace. All right. So overall, just doing a quick recap of all the fundamentals that we've been covering from all the way back on August 12th, when price was way below the 1.300, calling for higher prices, over 100 pips called out in advance. Now let's go over this breakdown. If you guys don't have this open in the Zoom call chat, you guys can click open this little tiny questionnaire. And I want you to drop your answers in the chat. You can just drop 1A, 1B, 1C, 1D for number 1 when we cover that. And then you'll do the same for number 2, same for number 3, same for number 4, same for number 5. So let's go over number 1 first. All right. And we'll try to break this down as we go. Let's zoom in so you guys can see. All right. So question number 1. And there's no wrong answer at the end of the day. I just want to see if you guys are learning. What is the significance of central bank divergence between the Bank of England and the Fed in relation to the Great British Pound against the US dollar? A, it leads to synchronized rate cuts by both central banks. B, it affects currency strength by creating differences in the pace and the extent of rate cuts. C, it results in higher inflation rates in both the UK and the US. Or D, it causes both currencies to weaken equally. I'll give you guys a minute to answer in the chat. All right, good job. So most of you guys said B, right? And that is correct. It affects currency strength by creating differences in the pace and the extent of rate cuts. So we've seen over the past consecutive couple of trading sessions, more demand for the Great British Pound and less demand for the US dollar as market makers started to price in less rate cuts from the Bank of England and more rate cuts from the Federal Reserve, which creates less of a demand for the Great British Pound or the US dollar and more demand for the Great British Pound as investors start to anticipate that they're going to get a higher rate of return holding their assets denominated in the Great British Pound. All right. Does that make sense? Okay. Number 2. All right. Let's go over this. Number 2. How does a smaller rate cut by the Bank of England compared to the Fed impact the Great British Pound up against the US dollar? I predominantly just gave you the answer, but still, go ahead and try and answer it. So A, it weakens the Great British Pound relative to the US dollar. It has no impact on the exchange rate. It makes the Great British Pound more attractive, potentially strengthen it against the US dollar. Or D, it causes both the Great British Pound and the USD to lose value. All right, good job. So most of you guys submitted an answer, and it is 2C. It makes the Great British Pound more attractive, potentially strengthening it against the dollar. So let's just kind of zoom out and reverse roles. If all the past 2 previous weeks, we saw bad UK data, horrible UK retail sales, horrible PMI figures, horrible inflationary figures, so on and so forth, right? What would that have most likely done? It would have reversed roles. Whereas instead of market makers pricing in less rate cuts from the Bank of England, they would have started to price in more rate cuts from the Bank of England. And then let's reverse the roles. Same thing. You've seen over the past 2 weeks, we've seen horrible data from the US come out. Not necessarily horrible, but we've seen downbeat unemployment claims, horrible labor market figures. We saw a revision in the labor market data that we have not seen since the 2009 global recession, right? And we've also seen Fed speakers come out extremely dovish supporting rate cuts. Let's flip the script and let's say UK data came out extremely horrible. UK speakers from the central bank came out extremely dovish. Reverse the roles, Fed speakers came out extremely hawkish, and US data came out extremely supportive of the US economy, where we saw labor market figures come out extremely healthy, optimistic, showing signs of strength and resiliency. We never saw a revision of the labor market figures, signaling recessionary fears. That scenario, inverse to the one that we are currently living through, would have created less demand for the Great British Pound, more demand for the dollar, and we would have seen GBP USD sell off as the dollar would have increased in strength and the Great British Pound would have decreased in strength. And so moving forward, forward looking, you guys now know that if we are operating in an environment where that scenario unfolds, you know what side of the market to potentially be on. You know to be in shorts on GBP USD instead of buys like we have been over the past 2 consecutive weeks, right? Makes sense? Number 3, why might investors shift capital towards the Great British Pound in the context of the Bank of England and Fed rate cuts? A, because the Bank of England is expected to raise rates faster than the Fed. B, because the Great British Pound offers a higher yield due to a less aggressive rate cut. C, because the Fed is expected to halt all rate cuts. Or D, because the US economy is perceived as stronger than the UK economy. So again, why might investors shift capital towards the Great British Pound in the context of the Bank of England and Fed rate cuts? All right, good job. Most of you guys said B, which is correct. Why might investors shift capital towards the Great British Pound in the context of the Bank of England and Fed rate cuts? It is B, because the Great British Pound, in this scenario, it doesn't necessarily offer more higher yield yet, but the market makers, because of the Bank of England and the Federal Reserve divergence, they're anticipating that the Great British Pound is going to, in the near future, offer a higher yield due to a less aggressive rate cut, right? So over the past consecutive 2 weeks of trading sessions, we've seen way more demand for the Great British Pound as investors are hedging against the future of more rate cuts by the Fed, which is going to create less demand for the dollar. And it creates an environment where more demand is driven into the Great British Pound. 2 more questions. What effect does a dovish Fed have on the US dollar index, the DXY, and the Great British Pound? Again, what effect does a dovish, that's a keyword, Fed, have on the US dollar index and the Great British Pound? A, it strengthens the DXY. B, it has no impact on the DXY. C, it weakens the DXY and could strengthen the Great British Pound if the Bank of England is less dovish. D, it strengthens both the DXY and the Great British Pound. Okay, so I'm going to go over this because I saw a mixed answer. Ken said D. I'm not too entirely sure if you meant that, but D is incorrect. It is C. Let's talk about this though, Ken, so that way you understand. So remember that when a central bank is dovish, right, they are dovish for multiple different reasons. In the context of the Federal Reserve, inflation has come down over the past consecutive couple of months. They're in a process where the economy is relatively weak and unstable. And so, with that being said, a dovish sentiment from a central bank usually tends to bring weakness to that domestic currency. Vice versa, if this question said hawkish, that is the opposite of dovish. Okay. Dovish tends to weaken said currency. Dovish sentiment from central banks tend to weaken said currency as market makers start to price in interest rate cuts. Lower interest rate environments tend to lead to less demand for said domestic currency. A hawkish perspective or tone from central banks tends to lead to central banks hiking interest rates or increasing interest rates. Higher interest rate environments lead to investors getting more of an interest on said domestic currency, i.e., holding assets denominated in dollars, which then tends to create more demand for dollars. So, in the context of the Federal Reserve, most recently, they have held a more dovish leaning tone, where multiple central bankers, as I've mentioned to you guys in these breakdowns, for example, Neil Kashkari just the other day, you can see right here, Fed Kashkari says it's appropriate to debate September rate cuts. This is a dovish tone. If Neil Kashkari came out on August 19th and said he doesn't see rate cuts on the table, he doesn't see support via the economic data, possibly ushering in rate cuts. He thinks the labor market is doing swell. He thinks inflation is still too sticky and troublesome. Those would have all been hawkish comments and would have most likely driven more demand for the dollar. But he didn't. He maintained a dovish sentiment by supporting rate cut bets, mentioning that the economy is in a possible place for the Fed to consider starting to cut rates. You can see right here, he mentioned weakening labor market figures. He also mentioned declines in inflationary readings. And so, just so that way you're clear, that tends to weaken the DXY and tends to strengthen assets traded against the dollar, which in this context is the Great British Pound. All right? Just so that way you understand, Kenneth. All right? No wrong answer, but still, so that way you learn and so you understand. All right? 5. How might investors' perception of economic strength influence the Great British Pound against the US dollar during periods of central bank divergence? Think about that. How might investor perception of economic strength influence the Great British Pound? So before you even answer this, think of yourself as an investor, right? You have $1 billion, right? You have $1 billion and you can't see the charts at all whatsoever. Let's pretend for 1 second we don't have access to TradingView, right? You get two fundamental reports. You get the UK retail sales figures and you get the US retail sales figures. And you see with your $100 billion, you're like, I want to invest this money. I want to hold it in an asset. And the two assets that you have to decide whether to hold that $1 billion in is either the Great British Pound or the US dollar. And you get the reports from the retail sales services sectors for both economies. And you see that the UK economy, United Kingdom economy, is flourishing. It's doing extremely well. People are buying things, everybody's healthy, everybody's got money, things are going smoothly, everything's looking great on paper. You read the US report, and nobody's buying anything, everything's falling to shit, nobody's economically strong, nobody's got money, everybody's sad, everybody's depressed. As a $1 billion investor, where are you going to want to house your money? It's most likely, if you're a smart, intelligent investor, going to be in the economy that's performing better, right? So that means that you're going to want to have your $1 billion denominated not in US dollars, but instead in the Great British Pound. So for this, how might investor perception of economic strength influence the Great British Pound up against the US dollar during periods of central bank divergence? A. If the Bank of England is less dovish, investors might see the UK economy as stronger, boosting the Great British Pound. B. A dovish Fed would make the US dollar more attractive, weakening the Great British Pound. C. Central bank policies do not influence investor perception of economic strength. Or D. The Great British Pound would weaken if the Bank of England is perceived as less confident in the UK economy. Okay. So Avidwa, I believe, is the one who got this one right. A and D are both true. So if the Bank of England is less dovish, investors might see the UK economy as stronger, boosting the Great British Pound. Remember, a less dovish central bank tends to benefit said domestic currency, right? So that means Less dovish, because you need to pay attention to this vocabulary, means that they are what? Means that they are more neutral or means that they are more hawkish. And you need to make sure you pay attention to that because sometimes in these reports that you're reading, they will not write out the terminology hawkish. They will not write that because they know that retail investors will read that and automatically think buy, right? So they'll switch up the vocabulary and try to confuse you by throwing in that dovish sentiment. But because it has less right in front of it, that means that they are something else. They are either more neutral or they are more hawkish, right? And then D, the Great British Pound would weaken if the Bank of England is perceived as less confident in the UK economy, right? So good job, guys and gals. Overall, I hope that you guys have enjoyed this type of review. I will continue to try to do these reviews every other, couple of weeks or whatever. I know that they're a little bit extended and long, so we won't do them too often. But after we've come out with a slew of fundamental reports and proper technical analysis that comes into fruition, after we gather like 3 or 4 reports and maybe 2 weeks worth of data, I'll try to do these kinds of breakdowns so that way you guys are really starting to learn and digest the information. Okay. And then hopefully over time, you guys grasp these concepts. I didn't have anybody to do this for me when I was learning this shit. And so I hope that it helps because I know that learning this stuff personally firsthand by yourself, it freaking sucks. So, um, so let's continue. Okay. I just want to go over my trade from this morning. A really nice, simple scalp. I caught the move on the 1 minute time frame. I believe my position is still on here. Yep, right there. I entered in with a buy stop. And so we're going to break this down from the 15-minute time frame and then we'll go lower. So overall, now you guys know the higher time frame perspective. By going over these fundamental reports, you all should know that on the higher time frame, which remember at the end of the day, as investors, as day traders, for me personally, this could change, right? For institutional scalper, it could be different because he's a high frequency scalper. For other individuals in this space, it could be different for you. You may like to sell. You may like to buy. You may like to do both in the same trading session if you see those types of setups where you're buying one session and then right around the next, after you get out of buys, you jump into sells and you play the market ping pong. For me, I don't like to do that. I am the type of trader that likes to create the least amount of stress in my trading environment as possible. I look for 1 to 2 trades per week, and I like to trade in tandem with the higher time frame order flow. Well, we just went over the past 2 weeks, higher time frame order flow because of the fundamental environment has been bullish, right? For the Great British Pound up against the US dollar, if we zoom out, we get rid of all the drawings real quick, and we just look on the 4 hour time frame, you can clearly see as day. Anybody denying this, that since what, the beginning of August, pretty much, Wednesday, August 7th, on the 4 hour time frame, GBP USD has been going up, right? Why on freaking earth at any point in time, again, this is my personal opinion, because if you caught some sell scalps, cool, so be it. But why on earth, if you knew, based off of fundamental factors, that the Great British Pound was going to be stronger than the US dollar, why on earth would you want to be selling? It's just like crypto, right? If crypto's in a bull market, why would you want to be selling it? You wouldn't. You have to treat futures, forex, stocks, whatever it is that you're day trading the same way. You don't want to be caught on the opposite side of the order flow because your stop loss is going to get eaten. You're going to be confused. You're going to beat yourself up and you're going to just dig into your capital. Makes no sense, right? So I always try to teach you guys, because that's the way I trade, to trade in tandem with the higher time frame. What is the 15-minute and above doing? The 15-minute and above in the context of GBP USD has been bullish. So that's why I mentioned to you guys in my pre-plan analysis, as long as price is above the 1.29500, I am going to remain bullish, right? The reason why I mentioned that to you guys is because if we look back at where that psychological level comes in from, that's roughly around the beginning of the week's lows. So you can see Monday, right? Monday, when the markets opened here, here's Sunday, Monday rollover. My first area of interest for a deep pullback was Monday's low, coming in at roughly around the 1.29400. Above that was the second weekly low at roughly around the 1.29750. And then where I sent that out to you guys, price was all the way up here. So the reason why I sent this to you is because on the weekly time frame, remember, these are weekly lows. This whole entire area of price action is one bullish candlestick. Okay. So the weekly momentum is to the upside until this weekly momentum is broken with bearish candlesticks, at any point in time that price comes into discount, we have to be adjustable because the market could see that as a discount from previous daily lows and flip around and turn bullish, right? So that's why I was giving you guys these areas of interest. But to jump down to the 15-minute and really break this intraday trade down, all right? So number one, we have the pre-plan analysis. Always make sure that you're doing a pre-plan analysis, understanding how to react intraday to fundamental factors that come out. Remember, myself and Institutional Scalper, we had a discussion in the chat the other day where we were talking about just because fundamentals come out bullish does not mean that it's going to drive demand for said domestic currency. You need to understand that sometimes these market makers will manipulate fundamentals where they will come out extremely bullish, but price is already in a premium and you will actually see the market sell off. Understand that these market makers have the power, right? So let's say, for example, the news comes out up here. Up here is 5:30 a.m. And a lot of times what you'll notice is that before the news event, price is appreciating in value. Then once the news event comes out, retail is anticipating the news. Market makers have already been buying up price. The news comes out bullish. It sends a nice bullish pump, enticing retail traders to buy. And then the market turns around and dumps, right? If you've been an investor or a trader in this space, you've seen this happen multiple times, and you will be left confused wondering, well, why, if the news was bullish for said domestic currency, did the market tank? And it is because these market makers have the power and the information to price in the fundamentals. They already priced in the bullish fundamentals that were released up here. They push price down into a discount, liquidating all the retail investors that were buying here, based off of retail strategies like trend continuations, EMAs, right? Liquidating everybody's stop losses. They will then reaccumulate orders at a discount from where they originally bought from or lower, and then drive price higher, continuing the trend. So just because fundamentals come out bullish, don't just assume that price is going to go higher. As above, so below, same thing, right? Just because fundamentals come out bearish, don't just assume that prices are going to go lower. Always assume that the market makers are going to try to screw you over, right? And when you start to think that way, you start to react to the higher time frame instead of reacting impulsively to the fundamentals, right? You start to look for setups and you stop anticipating the market. All right. Anyways, all right. So I just wanted to break that down for you guys real quick. Overall, though, so looking into the UK fundamentals, I went over this for you guys just a second ago. We had the UK private sector, the PMI figures come out relatively upbeat for the UK. I saw that created an area of interest where market makers during London session were buying. 15-minute time frame. We created the institutional pattern that we look for in the CYPRX 2.0 material, where we see lower time frame trend continuation. I'll jump down to the lower time frame in just 1 second. But overall, this bullish candlestick right here is what broke 15-minute structure for me, where we can see sellers temporarily in control of this price action. Market consolidated as market started to build liquidity in this consolidation range. It was determining whether it was going to go flip bullish or bearish, given the news that was set to come out. News came out at 1:30 a.m., positive for the UK PMI figures, and market makers bought price. This to me was a break of market structure on the higher time frame on the 15-minute, so I annotated that. Right? Now, keep in mind, higher time frame, 4 hour and above is bullish. We've now just identified rolling into New York session because when I opened my charts this morning, it was roughly around 6:45 a.m., which is roughly around 4:45 a.m. Pacific time, right? So that was roughly when price was around here. Now, remember, I don't trade during the manipulation window, i.e. the first hour of the New York session. I wait until after 5:30 a.m. when the news comes out to place trades. So I knew right off the bat that the market was hovering around a discounted area on the 15-minute from where they previously bought from. This being the area where market makers previously bought from, we can see an increased demand for the Great British Pound, breaking previous bearish market structure. And that just so happens to be exactly where the UK fundamentals came out. If you go look at forexfactory.com, the UK fundamentals came out at 1:30 a.m. Pacific Standard Time. Knowing that the higher time frame, 4 hour and above, is bullish, now knowing that the 15-minute time frame was bullish, when I started looking at the charts during New York session, all that was left for me to do was to jump down to the lower time frame and identify, because again, this is the pattern that I personally look for, to the left-hand side, a low, a sweep of a low, a higher low that comes in after, that created the 15-minute pattern that broke the market structure. And then all I simply do is I wait for a pullback to come back down into that area of interest to then place a buy continuation position. Right? And we can see that unfold right here. Give or take supportive fundamentals, because at 5:30, what did we have? We had higher unemployment claims come out. I know as a fundamental trader that when we see dwindling labor market figures, weak labor market data, or cooling labor market data, i.e. higher unemployment claims, come out on the US front, that tends, whether it be temporarily or permanent, tends to drive less demand for the dollar and more demand for the Great British Pound. So when I saw this report came out, it just solidified my overall bullish bias. Jumping down to the lower time frame on the 1 minute, keeping in mind that this arrow right here was that 15-minute area of interest, i.e., so now we can see how this 15-minute candle has now broken down fractally. This is that 15-minute candle that broke that structure over to the left-hand side. And we can see the institutional pattern play out. Market makers created a pocket of liquidity underneath of lows here and here. They swept those lows. They reversed structure, created a higher low. And right here is 1:30 a.m., right when the news came out. And we can see a massive injection of liquidity into the market. Boom. Price expanded. All that was left for me to do during this New York session was take my Fibonacci to confirm that price is coming down into a discount from the low where market makers came in from during London session, extend it up to the high, and wait for price to come down into my discounted area, which for us here at CYPRX preferably is anything below 79% discount to get the best risk to reward ratio. Well, during New York session, remember, I don't trade in this area, which is the manipulation range for me. I wait for price to break out after 5:30. Interestingly enough, right at 5:30, you can see price tapped down into, here's 5:30 a.m. Pacific Standard Time, right when the news came out for unemployment claims this morning. You can see that here. Let's go back. Look at this, 5:30 right there. All right. You can see that here's the candlestick where the news came out. And remember, just like what I said to you guys, what do the market makers usually like to do? Here you can see them price in the higher unemployment claims. They liquidate people that sold early above these highs, and they liquidate people that bought early beneath these lows. I saw that internalizing the data. And remember, I just mentioned to you guys to trade a couple minutes after the news. All I simply did was I placed buy stops above this bearish candlestick, and I put my stop loss beneath the low from where London session had bought from. Because ideally, if this low is broken, it makes logical sense. Remember, this is the 15-minute low, that if this low is broken, that would entice a market reversal. If a 15-minute area of interest is broken to the downside, keep in mind that this is a higher low on the 15-minute, that would be a moderately higher time frame area of interest broken to the downside, and that would be when we consider a possible trend reversal. Think of everything that I've explained to you so far. Higher time frame 4-hour, bullish. 1 hour, bullish. Fundamentals during London session supported demand for the Great British Pound. Fundamentals now at 5:30 a.m. during the beginning of New York session supports demand for the Great British Pound, less demand for the US dollar. All that was left for me to do was place a buy stop and a nice stop loss and ride the wave. I waited. 5:34 a.m. came around, tapped me into the market. No drawdown whatsoever. My take profit one was above the highs prematurely during New York session prior to the news, where market makers were again building liquidity in terms of trendline traders. You can imagine how many retail traders trade trend lines were trying to sell, 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 prematurely guessing the news direction, and all of their stop losses got ate and liquidated. Simplistic in and out of the markets, 1-to-2 risk reward ratio. I think I secured 20 pips. I closed this. I didn't get 22. I think I made like 20. Actually, I think honest to God, it was 19. So boom, this was my trade this morning. Now, the market did reverse after some supportive fundamentals came out for the US dollar. We're at 6:45 a.m., which is another 15-minute interval. You guys can see here at 6:45, the news came out supportive of US dollar strength. US dollar gained strength against its rivals after the PMI figures showed that the private sector continued to grow at a healthy pace. And look, just to reiterate what it is that I'm trying to teach you guys, these market makers, they started selling before the news. They started taking profit well before the news, over 30 minutes almost, 15 minutes before the news. Here's 6:30 a.m. when they started dumping their positions, their buys. News comes out, supportive of the dollar. Dollar gains strength against the Great British Pound, and they further sell their profitable buy positions. So very simplistic, in and out. Remember, it doesn't matter if you're a buyer or a seller. You can catch these moves by understanding these market fluctuations, these fundamentals, and very simplistic technical analysis dynamics. Nothing complicated about today's trade. CYPRX 2.0 material and 3.0 content to the T, paying attention to time, trading with a higher time frame, not anticipating the market, not over trading during manipulation windows, waiting for price to come into discount, setting buy stops, and setting sound and logical risk to reward ratios. Very simplistic. When you take all of this away and you pretend like we didn't just do a fundamental breakdown, this just looks like crazy ass price action, right? So anyways, hopefully today's breakdown helped you guys out. Hopefully the way that I broke all this information down for you guys was easily digestible. And if you like this, give me some feedback in the Cypress chat, and I will continue to do this every so often once we have some data to go over and a collection of reports to cover looking back month after month. Did anybody else this morning catch this trade? I saw Emiliano catch this trade this morning. I saw Angel catch this trade this morning. Anybody else in the chat catch this trade or at least understand what happened in the markets this morning?
I do understand, but I didn't catch it.
Heck yeah.
Didn't place the trade. I saw in London after the news came out. Wanted to place the trade, but I'm already 3% up this week, so didn't want to
Good
go
job,
further.
amigo. Don't be greedy, bro.
I'm already 3%, so I saw it, I played, but I didn't place the actual trade, so I'm happy.
Yeah, we're at a
I
very
was curious in the New York session, but I was actually busy at that time, so I didn't watch it. But when I come home, I saw the price action, and damn, it's so accurate.
yeah, we're at a very interesting turning point on GBP USD. I've noticed that almost every single time, most recently, that GBP USD has printed two bullish weekly candlesticks, prices pulled back. For example, here, here. So I'm interested to see how price unfolds next week, whether we see a market continuation and we start to poke above these highs coming into these previous areas from back in 2022, or whether we pull back. So next week will be very interesting. But yeah, easy peasy. I mean, we predicted this whole entire bullish leg on GBP USD pretty much from the bottom. We started anticipating this at the 1.275, and we're now well above the 1.300. So it's going to be interesting to see how things unfold via the central banks over the next couple of weeks as we roll up into September. So as always, I'll keep you guys at the forefront. Make sure that you're reading these reports and make sure that you guys are staying actively involved. Let me let me just take a break real quick. I'm going to stop this recording so that way this one ends. I'm going to start a new one with the same Zoom link. So just give me like, I don't know, 3 or 4 minutes while this Zoom link loads real quick so I can save it to my computer. And then I'll come back on and we'll just read a couple of pages from this As a Man Thinketh book, and then I'll let you guys go for the week. All right. I'll see you guys back on in like 5 minutes for those of you all who want to listen to me read some of this book, maybe talk about it.
Okay, waiting.